Struggling to find money to grow your business? Today, I'm going to break down the real ways entrepreneurs can get funding, from traditional banks to the SBA to investors, so you know exactly where to go and how to qualify. Every business needs capital, whether it's for inventory, equipment, hiring, or expanding into new markets. Without the right type of funding, even the best business ideas can stall. Knowing which funding source fits your situation can save you time, money, and stress. Traditional banks offer some of the lowest interest rates and dependable repayment terms, but they're also the strictest when it comes to approval. You'll typically need a strong personal credit score in the 700 seconds or higher and solid business financials. Banks want to see years in business, consistent revenue, and good cash flow before approving a large loan. The pros of bank loans include lower interest rates, flexible repayment terms, and no equity given up. The cons are that they are harder to qualify for and have a longer application process. The Small Business Administration, or SBA, doesn't actually lend money itself. It guarantees loans made by partner lenders like banks and credit unions. Because of that guarantee, SBA loans often have better terms and higher approval rates for qualified borrowers. Common SBA loans include 7A loans, which are most popular for working capital, equipment, or expansion, and SBA microloans, which are smaller amounts up to around $50,000 and great for startups. To qualify for SBA funding, you generally need a strong credit history of at least 690, a solid business plan, financial documentation, and sometimes collateral or personal guarantees. The SBA process takes longer than online lenders, but the terms can be more affordable and borrower-friendly. If your business has high growth potential, especially in tech, SaaS, or scalable consumer products, investors may be a better fit. Unlike loans, investor funding is not debt. You exchange ownership, or equity, for capital. Angel investors are usually individual wealthy investors who provide early-stage funding and mentorship. Venture capital involves larger sums of cash with strategic growth support, but it often requires fast scaling. The pros of investor funding are no monthly payments and potential strategic help and networking, while the cons are that you give up part of your company and VCs often expect rapid growth and high returns. Aside from banks, SBA, and investors, online lenders offer lines of credit, short-term loans, and equipment financing with less strict credit requirements. These options are faster, often approving in days, but may have higher interest rates and shorter repayment terms. Understanding the landscape of business funding, bank loans for stability, SBA loans for great terms, and investors for growth gives you more power and choice as an entrepreneur. Don't settle for the first option you find. Match the funding type to your goals and business stage. If you want me to break down exactly what type of funding fits your business idea, drop a comment with your industry and revenue stage. And don't forget to like and subscribe for more financial strategies.